Hello traders, welcome to another episode from your favorite channel, Forex Chat. And in this episode, we are going to talk about a Forex trading strategy, right? And what is a strategy? I'll give you an example. Now, I'm sure you are acquainted with how the Forex market works, right? And I'm sure now you know that what we are going to do in the market is to look whether the market is buying, or it's going up or down, so that we look for buys or sells. But how do we see whether we need to buy or sell, right? We use what is called a strategy. Just like if you're going to war, you need a strategy. Trust me, my friends, this is another war that is ahead of you. So you need to have a strategy, right? There are many strategies out there. You can use robots. There are what are called indicators like Bollinger Bands, moving average, MACD, whatever, and all of them work. They are even technical strategies like ICT, market maker, peak formation. It's a lot of them. But as for us, we will be using a strategy called price action. Why do we use price action? Because price action understands what price is doing, right? So let's jump into the definition of price action. Price action is a strategy. Price action strategy is a trading approach where traders use or analyze the price movements of an asset to determine potential entry and exit points. I'm sure that was clear. We're just using price movements. We're looking at price movements to see whether the market is like if we see price movements, whether it's going up or down, we can look for entry points using that. So it's basically just analyzing the history to determine what it will do. That's basically what price action is about, because they say the market has a memory, right? It's like if a car is moving at 180 and you know that it's moving at 180, if you do your math right, you can find a proper way of just hopping on it, because you know there's no way it's just going to turn around and change course. So that's what basically price action is about. So the first thing you should do when using price action is to look for direction of the market. All right, what is the direction of the market? You need to understand, guys, that at any given moment price is doing three things, right? It is either going up, which is bullish, it is either going down, which is bearish, or it is playing within a specific zone, which is called ranging, right? It's either doing any of these three things at any given moment. So what we're doing when we say we're looking for market direction is we are looking for whether the market is bullish, bearish, or ranging. That's basically it. So what is a bullish market? A bullish market is a market that is going up. Like I told you in the previous video. How do you see now that your market is going up? I want you to pay close attention to this, because this is what all market direction is about. Do you see here that this is our starting point of our price, right? This is a low, right? And price went to this high. Our first sign that price is bullish, it went up, right? And then because price does not move in a straight line, it comes down. Why does price come down? Let me give you an example. Let's say you are buying a commodity, right? You're buying, I like to use bread, because everyone eats bread. I hope everyone eats bread. Let's say you're buying bread, right? You start buying bread at $1. That's okay. You buy at $2. That's okay. You buy at $3. That's okay. You buy at $4. if you are a smart person, when you go back to the market and they say now bread is at $5, you may buy, but that will be the last time you go there, because this is now too high for me. I will go broke trying to buy rice. So what do? Now you wait for price to come down a little so that you continue to buy bread again. You see that? So when that coming down is what is happening for every commodity, for every price, right? That's why you see that the market does not move in a straight line, right? But the funny thing about going up, there is no such thing as called expensive, right? There is only a thing of you getting used to a certain price, right? Let me give you an example. Do you remember a time if you're in Zimbabwe, there was a time that it was announced that the price of fuel was about to go up, right? And there was a massive protest. It was so massive. Do you remember that time they had to close the connection because the riots were becoming too much? They had to shut down the networks because the riots were becoming too much. But you also know that price that people were striking for is actually lower than the current market price of fuel. So why were people rioting then and not rioting about the current market price now? It's actually a case of getting used to it. You get it? Then I don't remember the actual prices, but let's say petrol was at $1.20, right? And they announced that petrol is going to $1.34, right? And people were upset. They were upset about it. But now I think the current market price of petrol is around $1.70, $1.80 there. No one is complaining because now we're used to it. So it means expensive is only when you're comparing it to something. You get it? So what happens when price goes up, like the actual movement of price? It goes up. Where is my mouse? All right. It goes up to this high. People find it too expensive. And then it goes down. People find it a good price for them to buy. Remember, we are talking about financial institutions. These are really smart guys. They look for price that are comfortable with them. Do you remember when we talked about liquidity providers? Do you remember that conversation? So in real life, the people who are actually active in a market are the liquidity providers. Do you remember them? The banks, right? And they buy currencies at certain rates, right? As you can see here, the market starting price was around 104, right? I don't remember what, but I think this should be USD/JPY. That's the pair that usually gives prices like that. And then it went all the way to, it was around like 105. And the banks will be like, this rate is too high. Let's hold all purchases, right? And then they hold because now everyone is selling because it's a good rate. Now it comes down. The banks realize this is a good price for us. And then they buy there. I'm sure it's around 104 from 105. They're like, a good rate, they buy. Price goes up again, right? But because these guys actually analyze external events and what, they realize, you know what? 105 is actually not a good price. It's not a bad price. So they continue buying because now they're used. Last time it was expensive. Now it's okay because they're used to it. Because the conditions that they want allow them to make a profit if they continue buying, right? But then it continues to go up. It continues to go up all the way to this price right here. They're like, hold on, this is now too expensive for us. We'll stop buying here. And then it comes down. It comes down to this price. They're like, this is almost that 105 that we had last time. Good price. Do you see now? Expensive last time is now cheap this time. So that's just what happens when a market is bullish. That's why the market never moves in a straight line. It's everyone is trying to buy at a good price. Everyone is trying to sell at a good price. So it moves. That's why you get these zigzags in the market. But as a price action trader now, that is what you go and look for, right? Because in a bullish market, we say we want to buy, right? And when we are buying, we want to follow the liquidity providers, which are the banks. So what do? We find the price makes this high, right? We find that it goes, makes this low, makes this high, makes this low, but this low is not lower than this low. This low is not lower than this low, yeah. So we know that the banks are still active. They still are bullish. They still want this. They still buying, but they're just looking for a good price because this low didn't take out this low. If it had taken, we would realize now they are no longer interested in this thing going up. They now want it to come down because everything is just too expensive. But as long as the lows are higher than the previous low, it just tells you that they are getting used to the new price that is being introduced, and they'll continue buying and buying and buying. I hope I tried to make this make sense, because this is the foundation, guys, of price action. If you don't understand market direction, you can never make a price action trader. As a matter of fact, I'll say this, you can never make a trader. So if you didn't understand that part, please try by all means to understand it. I'll try to re-explain on the bearish market. So it says here, as long as the market continues to take out the previous high and fails to take out the previous low, we say the market is bullish. I hope I made a lot of sense there. So this is an example of the market in reality. You can see that it started at this low here, right? Went out, gave you this high, made this low here, went up and gave you this high, this low here, went up, gave you this high. You know, it's creating what are called higher highs and higher lows, right? When we're using the actual price, technical price action terms, we're saying the market is creating higher highs and higher lows. But I want you to take note of something. Do you see how we have two highs here, right? This is where traders are separated here, because these are arbitrary. These highs are not clear as they used to be here, right? They are not as clear as just, you have to choose which highs you want. Which highs you want. But the thing is, when you choose a high, you have to stick by it. I hope I'm making sense there. When you consider a high, I'll give you an example. Let's say this is a high, right? This is a low. This is a high. This is a low. I can safely disregard this as a low if I want, and consider and say from here my next high is here, and not this. I will not consider it as a high. I'll consider this as a high. The thing is, when you are now analyzing, you have to stick by that. These things are arbitrary. One thing about trading is you have to be confident about what you're saying. So in actual real market conditions, these highs are not crystal clear as you guys would expect. Even, let's say, I could have picked this high, higher high. I could have called this a higher low, right? And called this a higher high. This one, I could have called this right here a higher high. That is totally arbitrary. You choose what you want. So let's move to the bearish market. When we say the market is bearish, it continues to make lower lows and it fails to break the previous high, it makes a lower high. I hope I'm making sense. It's actually, the term here is not supposed to be higher low, it's lower high. It's fine as long as you get the statement. So as long as the market continues to make lower lows and fails to take out the previous high, it is a bearish market. I'll give you another example here. Let's say you are selling something, right? And this is the actual price of the commodity. It starts at 10. It's a good price, right? I don't know whatever you're selling. Let's say bread. You're selling bread for 10 bucks, really expensive bread right there. Goes down, goes down, goes down. Now it's selling at 8, right? Then you're like, hold on. Let's say it goes 10, 9.5, 9, 8.9, 8.6. It goes to 8, you're like, hold on. I want my bread expensive. So I'll wait for prices to come up a little bit so I can start selling, right? And you know that when the prices get lower and lower, you were selling at 10 and it's becoming at 8. It also means the buyers are like, wait, do you remember we used to buy bread at $10? Now we are buying, like, do you remember we used to buy bread at $10? Now we are buying it at 8. So they will become more active. If you understand the terms of demand and supply, when something is cheap, the demand for it goes up. When something is more expensive, the demand for it slows down, right? So you realize that the more sellers are pulling off, the more buyers are kicking in because it's expensive. What happens there? We have more demand than the supply. Some are pulling off, they want a good price. Continues to go up, go up, go up, go up. Now it comes to a price that is good, right? Because now everybody wants bread selling at 8 and it goes up, and everybody's like, wait, it's good, it's good, it's good, it's good. Now it's almost like 9.5. Everyone's like, no, this is almost the same price when it used to be expensive. What? You know, and the sellers are like, that is a good price for us. We need to buy, we need to sell now. We need to sell now. The buyer's like, nah, it's expensive. We need to sell now. It's expensive, you know, and they start bringing over their product and it pushes price lower. The buyers are like, hold on, is that $5? They come in their numbers like, we want to buy, we want to buy, we want to buy, we want to buy. And it pushes price up like that. And as it goes up, right? The sellers, they're like, the buyers are like, this is like getting expensive. And they're like, no. Do you remember that time we used to sell it? We used to buy it 8. The sellers are like, 8. 8 is a good price. They bring out their product. I'm sure you get the point of how market doesn't move in a straight line. It moves in that zigzag because there is always this tug of war between the buyers and the sellers. That's what causes price. But you as a price action trader, you need to see if it is still going down. How do you see that? You see that the low doesn't take out the previous low that was created. Simple as that. That's what you only need to see. And this is a typical example of a market that is going down. As it's going down, it's creating lower lows. The high is failing to take out the previous high. This low is failing out to take out this low. It's always taking out this low. I mean, the high is failing, the low is winning. The high is failing, the low is winning. It's just going down, dip. Simple as that, guys. Simple as that. Now let's move to a ranging market, right? So as long as the market continues to make equal highs and equal lows, we consider that market a ranging market, right? Let's say this is $8, this is 10, and price is just dancing around that, dancing around that, dancing around that. This usually happens. Have you ever heard what is called market capping, right? It usually happens in those economies whereby they are trying to control their currency. When they are trying to control their currency, they try to maintain a rate for it, a specific rate for it. They say our rate is always, let's say it's the puller. I remember the puller was capped at some point. It was always, I don't remember the price, but it was capped. So let's say it was at 8 and at 10. They always want price to range about around that. This is done, let's say, for trade reasons. This is done for economic reasons. It's done for those. Remember, we are talking about real money here. We are talking about the actual currency that affects our economy. So we want to make sure that usually when the market is ranging, they want to control so that there is certainty, right? Investors love a currency that is stable. Why do they love a stable currency? Because you can plan ahead of time, right? So you can have a market also ranging. What is this is a typical example of a ranging market. As you can see, I tried to look for a not very perfect example for you guys. Why? Because I wanted you to get a grasp of what the ranging looks like. Do you see how when price entered in this zone, right? It got there, didn't meet this previous high that was set, went down, met the previous low, acted like it's failing to take out the previous high. So now you're like, is that a sign for selling? And then it comes down, takes out the previous low, and you're like, yeah, definitely a sign for selling. And it goes there. Wait, where is my mouse? Okay, it goes there, taking out the previous low, clearly clearing out the rumors of a sell market, and then it just does that. It keeps dancing around this zone, tries to fake traders that is going up, comes back again, fakes them that is going down. That's how a genuine market does. You understand about this. Some like to call the manipulations, but I want you to understand that ranging bullish or bearish, it's not rock solid clear, like you have seen in the examples that I've shown you, where as opposed to the arrows, it's where it's crystal clear and there's a clear price and you can easily take on. So guys, this is an example of a typical market, right? A typical market has, when you just open your charts, there is a ranging, there is bullish, there is bearish, there is ranging, there is bullish. But a trader now, as a price action trader, you're supposed to separate that. You're supposed to know what is happening at any point in your market. If you are not sure of what is going on, you're supposed to exit that market, right? You're supposed to exit because you're not sure. You need to be sure. So now you know your market is ranging, right? And then it takes out this low, right? Goes there, takes out this high. That's a good sign. When it did this, you had a sign for bearish, right? It did that. It went there. You're like, oh no way it's going to be selling. It's now going up, right? And then it comes there, right? It respects it, goes there, and then it just goes up like that. And then when it starts going bearish now, I want you to take clear note of this. Do you see how the market takes out this low, right? And comes back again and fails to make a higher high there? That is a very clear sign for you that this market is now bearish. That is called a change in market direction. We will talk about, because as we can see now, you can only tell that it had changed direction because of when it already when like you only tell when it moves. But we will talk about in the near future, we'll talk about how do you see that the market is respecting this zone. It will be all in the future, don't worry about that. But now I need you to understand that a market, how does it change from being bullish to being bearish? This is what you see, a change of direction by breaking down the lower low and then failing to take out the previous high, right? You can even do this in reverse. If you have a pen and a paper, like I told you, try to design a market that is reverse. Starts out bearish, right? And turns out bullish. I just want to see if you are getting a grasp of these things. So change of direction. This is when a bullish market becomes bearish or vice versa. I'm sure you are like I was clear on this one. So usually these are some of the things that you can see when a market is changing direction. Or you notice that the market is going up, right? When it fails to take out this high, usually it respects this price. This where I shared here. My mouse is doing funny things today. All right. Do you see here this zone that I marked here? Market takes out previous low, right? Market fails to take out previous high. But how did it kind of respects the previous low with the previous high? Do you see that? That's how markets can show you sometimes that we are now changing in direction. Sometimes it can go a little bit higher. We'll talk more about that. But now I just wanted you guys to understand what we talk about when we talk about market direction. All right, so this is a typical market example of a change in direction. And it also shows you the zone that I marked. You can see that the market is going down, right? Goes high, fails to take out the previous high, goes down, right? Fails to take out the previous low, right? And like I told you guys, that the market now needs you to be smart, because if you can see here, right, the market fails to take out the previous low, right? And it fails to take out but you can see that it has not taken out the previous high, right? So it means my sell is still active. What am I telling you here? I'm saying sometimes you can see a market failing to take out a previous low, but as long as it has not met both conditions, fails to take out a previous low and takes out a previous high, you can consider it now a change of trend, like I'm going to talk about. But as long as it is failing to take out this previous high here, we consider it still as a bearish market. So it goes down there, finally it's able to take out the previous low, and then it goes up, right? Does a little bit of a range here, it goes all the way down, it's still bearish, it goes up, still respecting this high, goes low, right? Fails to take out this low. If you can see, the first time it failed was actually here. Fails to take out the previous low, right? Goes here, fails to take out the previous low. But like I told you, I am still considering my market bearish. Why? It has not taken out the previous high. I hope that is quite clear. But finally, it takes out the previous high. Combination of failed to take out the previous low and it takes out the previous high. Now I have two conditions met to consider, is this a change in direction? So the market comes back, right? And it actually respects this zone here and it goes up and up like that. I hope that is quite clear. But now we want to get deeper into becoming a better direction predictor, or whatever you call it. So we need to have, when we are looking for the direction of the market, right, we need to have use something that we talked about in the previous episode when we talked about time frames. This is an important thing when you are predicting, when you are trying to look for the direction of the market, because time frames are divided into two. They are what are called high time frames, they are what are called low time frames. So in the case of small time frames, that was a spelling error there, I wrote more time frames. Small time frames with M1, M5, M15, M30 and H1. But for price action traders like you and me, who only use M15, M30, H1, I can forgive you if you use M5. I would understandish, but it's M15, M30 and H1. Those are our small time frames. High time frames are H4, D1 and 1 week. I hope that makes sense. The 1M means 1 month. That is too high because it means in a year we only get 12 candlesticks. That is too high for the kind of trading that we do. So as for direction of the market, we only use high time frames for finding the direction of the market because they give the long-term view of the market. Let me give you an example here. Let's say you are a father or a mother, right? And you have 2 kids. One is like 2 years old, the other one is like 10 years old. And you were not home and you want to get an account of what was happening at home, right? You ask the 2-year-old, she'll be like, she will say everything. She will say, we went and played. No, we didn't play. We watched TV. No, we didn't watch TV. We ate porridge, and then we slept, and then we woke up and bathed. You see how it doesn't synchronize. But when you ask the 10-year-old now, she'll be like, Mom, we woke up, we ate porridge, we watched TV, and then we were tired of watching TV. We went out and played, and then we were tired of playing. We came back and got some food. You see, so that is the difference between high time frame and low time frame. High time frame gives you the actual, the long-term view of the market, what it is bound to do, right? But the small time frame, it gives you a lot of things. You can actually have a bearish market on the small time frame, in a bullish market on the high time frame. I hope that makes sense. So that is why we only consider high time frame when we are predicting the direction of the market. That is all, guys. All right, let's do something. Let's do a little bit of let's go to the market and see. I just want to give you guys a little bit of a run around the markets, try to see the direction of the market, so that I want you guys to do this. After watching this video, I need you guys to go to your market and try to see what is happening, right? I will use random examples, not the ones that I had set, so that you guys can actually see that this is very simple, very easy to do, and you can also do it by yourself. We said we look at 1 week, D1 and H4. So I go to my time frame here, it's 1 week, right? And then I try to look for the direction of the market, right? As you can see here, it was creating lower lows and lower highs like that, lower lows and lower highs like that. And then it I hope you can see here, this is the time it failed to make a lower low here, and it actually went and took out this market structure there, this previous low, right? And then you can see that it started going up like that. For in that time, it was in a bullish market, right? And then it goes down here, takes out the previous low, gives me a signal of a selling. But if you can see now, the market was actually ranging in this zone right here. In this zone here, the market was actually ranging, right? But now let's go and look at the actual current movement of the market here. The market started going down, right? Creating lower lows. And then I want you to notice how it's very hard to see this high low, because I'm on 1 week, right? It's giving me very clean candles that are just moving because it's 1 week, right? Let me change my time frame and move to D1, right? And let me see if I can get a clearer view on this market, right? I'll just take a snippet of this, right? Low, right? Creates a low right here, right? I'll start here, counting my direction here. So low, I'll say fails to take out this previous high, creates this high, makes a low here. Already I'm saying my market is bearish, right? So it comes down here, it comes here, right? Fails to take out this high, goes all the way down here, it creates this, right? And fails to take out the previous low. So now I'm considering there is a possible change of trend. It does that again, but this time it fails to take out this high. So my change of direction is not yet there, but it also fails to take out this low. I'm like, oh, this is a kind of a range, right? It's a range-ish. And then it does that again, fails to take out the previous low, fails to take out the previous high. This is definitely a range, right? And then it strongly takes out the previous high, changing my trend. And now I'm bullish. Gives you this, I am bullish now, goes there, goes. This is actually the market that I was looking at. Let me look for another example that I want, one that I hasn't. What can I look at? Which market can I use? Let me do USD CHF. Something that I haven't talked about. Just to show you guys, I hope it loads in time. All right. I want to look for examples. Yeah, this one has everything. There is change of trend and everything. I'll start my market, analyze my market here. Do you see it goes up, right? Gives me a higher low than this one. Goes up, taking out this high, gives me a higher low, goes up, right? Gives me a higher high, right? And a higher low, right? This time it fails to give me a higher high. Now I'm questioning it, right? But it also fails to take out the previous low. So now I'm not yet considering it bearish. It does this thing, but at this moment it takes out the previous low, fails to take out the previous high. I'm now considering it bearish. And then it does that, and that it's just melting like that. And that is what I call market direction. So when I ask you now, if you want to analyze a market, the first thing I ask you is your market bullish or bearish? If you cannot tell me whether your market is bullish or bearish, definitely there's nothing we're talking about. You are not in a position to be trading that specific pair. This video has gotten too long. Thank you so much, guys. Also remember, we talked about identifying if a market is bullish or bearish. 1, 2, we're using higher time frames. We could have gone to a smaller time frame like H4, but I'll leave that to your homework. Practice this as much as possible, and I want to see examples of things that you have practiced. Thank you so much, guys. this is the end of the video.